Ever wondered how to build lasting wealth through smart investments? Well, in today's video, we've got something extraordinary for you. Peter Lynch, How to Invest and Build Wealth. Are you ready to unlock the secrets to successful investing, learn from remarkable stories, and discover the strategies that could potentially transform your financial future? Of course you are. In this captivating journey, we'll explore Peter Lynch's profound investment philosophy, dive into success stories, and unravel the art of stock research. We'll navigate the treacherous waters of market crashes and unveil Lynch's tips for finding those elusive 10-bagger stocks. But that's not all. We'll also uncover the power of intuition in investments and discuss the importance of sustainable wealth creation. So, if you're ready to embrace the world of investing and embark on a path to financial prosperity, hit that subscribe button because you won't want to miss a single nugget of wisdom in this journey. All right, let's get started by uncovering Lynch's investment philosophy from the topic, How to Invest and Build Wealth. Imagine you're choosing the perfect recipe for a dinner party. You wouldn't pick a recipe without knowing the ingredients, right? Similarly, Lynch believed in understanding every ingredient of a company before investing. His philosophy was straightforward. Research, research, research. It's like when you plan a trip. You want to know the weather, the best places to visit, and how to get there. For Lynch, investing was like embarking on a well-prepared adventure. He emphasized thoroughly understanding businesses before diving in. Imagine you're meeting someone new. You'd ask about their background, interests, and values. Lynch applied the same curiosity to stocks. He famously said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." Imagine the stock market as a seesaw. Sometimes emotions sway it, but in the long term, it balances out based on a company's real value. Lynch was all about finding that real value. He encouraged investors to focus on what they knew, their circle of competence. It's like when you're giving advice to a friend, you speak about what you understand best. Lynch advocated investing in businesses that you could explain with simplicity, just like telling a bedtime story. One of his famous principles was to invest in what you know. It's like recommending a favorite restaurant to a friend. You trust it because you've experienced it. He believed that if you understood a product or service, you were better equipped to evaluate its potential as an investment. His philosophy was all about being a savvy consumer, but in the world of stocks. So, just as you wouldn't buy a car without test driving it, Lynch advised investors to thoroughly test drive their investments through research. Understanding a company's story, just like understanding a good book, was key to his success. Now, let's dive into some interesting investment stories inspired by Peter Lynch. Think of these stories as real-life treasure hunts that can inspire your own investing journey. Imagine you're in the position of Ronald Wayne, one of the co-founders of Apple Inc. Back in 1976, he decided to sell his 10% stake in the company for just $800. Fast forward to today, that 10% stake would be worth billions. It's a lesson in holding on to your investments for the long term. Another incredible story is that of Warren Buffett, often referred to as the Oracle of Omaha. In 1962, he began buying shares of a struggling textile company called Berkshire Hathaway. Fast forward, and Berkshire Hathaway is now a conglomerate with shares worth thousands of dollars each. It's a reminder that even well-established companies can be hidden gems. Let's not forget the tale of the happiest place on Earth. In 2005, Disney acquired Pixar for $7.4 billion. Fast forward, and Disney's acquisition has led to a string of blockbuster movies and the creation of the iconic Toy Story and Frozen franchises. It's a lesson in the power of strategic acquisitions, and who could overlook the story of Amazon? Jeff Bezos founded the company in 1994 as an online bookstore. It expanded into various sectors, and today, Amazon is a tech giant, offering everything from cloud services to groceries. The lesson here is that visionary leaders can take a company to new heights. These stories remind us that remarkable investments are all around us, waiting to be discovered. Like a detective on a case, you can uncover opportunities by keeping an eye on trends, staying open to possibilities, and having the patience to let your investments grow. All right, now let's talk about how to research stocks. from the topic how to invest and build wealth. Think of it as putting together a puzzle. You start with the corners and piece by piece you reveal the big picture. Peter Lynch had a knack for this. He believed that before investing, you should know what you're getting into. It's like preparing for a camping trip. You need to understand the weather, the terrain, and what gear to bring. His secret was to combine two types of analysis, fundamental and technical. Now, I know these terms might sound fancy, but they're quite simple. Fundamental analysis is like checking the DNA of a company. It means looking at its financial health, just like you'd want to know if someone you're dating has a stable job and a decent bank balance. You want to peek into the company's balance sheet, income statement, and cash flow. It's like opening a book and learning about the characters, their past, and their financial stability. You're checking if the company's income is growing, if it's got debts, and if it's making more money than it's spending. Lynch had this fantastic mantra, buy what you know. It's like picking your favorite ice cream flavor. You already know you'll love it. So if you're into tech, it makes sense to invest in tech companies because you understand the industry. Then there's technical analysis, which is like studying the company's stock price chart. It's similar to checking the weather forecast before your camping trip. You're trying to figure out if it's going to be sunny or stormy. Look for trends, patterns, and signals in the stock's price history. It's like reading the signs in nature to predict what the weather will be. You can use tools like moving averages, RSI, and MACD to help you. Lynch often combined these two methods, just like adding a compass to your map on a hike. It's about having a well-rounded view of the company and its stock. So remember, before you invest, get to know the company like you'd want to know your hiking trail. You'll be better prepared for the journey ahead. Now let's move to the next topic from how to invest and build wealth that is understanding market crashes. By the way, if you're enjoying the video so far and want more topics like this, comment the word more so I know. Ever wondered why they happen? It's like a sudden rainstorm on a sunny day. You're out having a picnic, and boom, the skies open up. Market crashes are pretty much the same. Sudden, unexpected, and often stormy. They're like a roller coaster ride where everyone screams, but nobody really knows when the next drop will come. So what's behind these crashes? Well, a mix of things. Fear and greed play a big role, a bit like how you'd feel if your favorite dessert was on a limited time offer. People rush in, buying stocks when prices are high because they're afraid they'll miss out. It's like everyone trying to get that dessert even if they've had enough. And then there's uncertainty. Imagine you're on a road trip with no GPS, no map, and no idea where you're headed. That's what uncertainty in the markets feels like. When investors aren't sure about the future, they get jittery, and this can trigger a market crash. Peter Lynch had a different approach to market crashes. Instead of panicking like most people, he saw them as opportunities. It's like knowing that when it rains, there's a good chance for rainbows to follow. When others are fearful, he saw potential bargains. He believed in buying more when stock prices were low, a bit like shopping during a clearance sale. So in his world, market crashes were not to be feared but embraced as chances to find stocks at discount prices. That's the lowdown on market crashes, friends. They're like sudden storms in the investment world. But if you're prepared, they can be your ticket to better deals. So don't let market crashes scare you off. Instead, see them as opportunities to build your investment portfolio. Now let's talk about balance sheets, a financial report card for companies. Think of it as a blueprint for a house. A balance sheet shows you what the company owns, what it owes, and what's left to call its own. So how does this all tie into how to invest and build wealth? Well, just like building a solid house, you need a strong financial foundation for your investments. On one side of the balance sheet, you've got the company's assets. These are like all the stuff you own, from your house to your car. In the business world, it's what the company owns, like cash, buildings, and inventory. On the other side, you've got the company's liabilities. These are like the bills you owe, such as your mortgage or credit card debt. In the balance sheet, it's what the company owes, like loans, debts, and unpaid bills. Now, here's where it gets interesting for our How to Invest and Build Wealth journey. The wealth-building part comes from the company's equity. Equity is like your net worth, the difference between what you own and what you owe. When a company's assets outweigh its liabilities, it's in a strong position. Just like when your savings and investments outweigh your debts. That's where the wealth-building magic happens. Peter Lynch knew that a company with a healthy balance sheet was like a well-built house on a solid foundation. It's less likely to crumble during economic storms. Investing in companies with strong balance sheets is a smart move because it sets the stage for long-term wealth building. So, as we continue our journey into how to invest and build wealth, remember that understanding a company's balance sheet is like examining the blueprint of your financial future. A strong foundation sets the stage for a wealth-building masterpiece. All right, now let's move to the next topic from how to invest and build wealth, that is the price-earnings ratio. Think of it as the price tag on a product in a store. It tells you how much you're paying compared to the earnings you get. Now imagine you're out shopping. You see two identical smartphones, but one is priced at $500 and the other at $1,000. Which one do you choose? The PE ratio is like the price tag. It helps you decide. The PE ratio is calculated by dividing the stock's price by its earnings per share. A high PE ratio, say 50, is like paying $50 for a $1 earning. That's like buying a smartphone for $1,000. It might be a great phone, but it's expensive. On the flip side, a low PE ratio, like 10, is like paying $10 for a $1 earning. It's a bargain. It's like finding a smartphone for $500, a great deal. So how does this apply to stocks? If a company has a high PE ratio, it might be overpriced, just like that expensive smartphone. It could still be a great company, but you're paying a premium for it. On the other hand, a stock with a low PE ratio might be undervalued, like a bargain smartphone. It could be a hidden gem waiting to be discovered. Of course, there's no one-size-fits-all answer. It depends on the company, its industry, and its growth prospects. Lynch used the PE ratio as a tool to evaluate stocks. He looked for those with reasonable PE ratios and solid growth potential. It's like finding a smartphone that's both reasonably priced and loaded with features, the best of both worlds. Now, let's talk about diversification strategies, the next topic from how to invest and build wealth. Imagine you're hosting a dinner party. You wouldn't just serve one dish, right? You'd have a variety of flavors to make everyone happy. In the same way, diversification in investing means spreading your money across different types of investments. Peter Lynch was a fan of this approach, and he had a good reason. It's like not putting all your eggs in one basket. You don't want all your money riding on a single stock. Think of it as having a safety net for your investments. Just like you wouldn't bet everything on a single horse at the race, you shouldn't put all your money into one stock. Diversification helps lower your risk. So, why is diversification important? Well, different investments can react differently to market changes. It's like having various tools in your toolbox for different jobs. When one investment isn't doing so well, another might be thriving. Diversification isn't about making a complicated stew with exotic ingredients. It's about choosing a mix of investments that suits your goals and risk tolerance. Whether it's stocks, bonds, real estate, or even a bit of cash, it's like crafting a menu that caters to everyone at your dinner party. Remember, diversification isn't a one-size-fits-all strategy. It's like tailoring a suit. It should fit you perfectly. You'll need to consider your financial goals, how long you plan to invest, and how comfortable you are with risk. In a nutshell, diversification is like spreading your bets, making sure you have different options on the table. It's a wise way to reduce risk and give your investments a better chance of success. So, like a buffet at your dinner party, keep your investment options diverse and appealing. Now, let's unravel the secrets of identifying those magical multi-bagger stocks that can supercharge your wealth. You know, it's like discovering a hidden treasure chest in the world of investing. And it's all about the journey to building wealth. First and foremost, when hunting for these gems, remember that Peter Lynch's "How to Invest and Build Wealth" mantra is your guiding star. It's not just about making a quick buck, it's about creating lasting prosperity. Think of multi-baggers as those rare, sparkling jewels that have the potential to grow significantly over time. They're like planting seeds and watching them flourish into towering oak trees that provide shade for generations. Lynch's approach to spotting multi-baggers was a blend of common sense and thorough research. It's a bit like being a detective. You start with a few clues and piece together the puzzle. He often emphasized investing in businesses that you understand. That's like sticking to the path you know well. If you're a coffee lover, consider looking into coffee-related stocks. Familiarity can give you an edge, just like how a seasoned traveler navigates better in a known city. Another technique Lynch used was to pay attention to the products and services he personally encountered. If he liked a certain brand or product, he'd investigate the company behind it. It's like finding a new restaurant with amazing food and then discovering it's a publicly traded company. To identify multi-baggers, keep your eyes open for companies with solid growth potential, especially those in emerging industries. It's a bit like investing in a small budding tree that you expect to grow into a mighty oak. Remember, spotting multi-bagger stocks takes time and patience. It's like nurturing a garden. You plant the seeds, water them, and give them the time to grow into beautiful flowers, and there you have it. It's all about creating a portfolio that can stand the test of time while you watch your investments grow into something truly remarkable. All right, now let's move to the next topic from how to invest and build wealth, that is market volatility and investment. Picture this. Investing is like a roller coaster ride, and market volatility is the twists and turns that make it exciting and at times nerve-wracking. So what's market volatility, you may ask? It's basically the wild swings in stock prices, like when you see a roller coaster climb up high then drop down suddenly. These swings can be triggered by various factors, from economic news to political events, and even tweets from influential figures. Peter Lynch was no stranger to market volatility. He knew that staying calm during these roller coaster moments is crucial. Imagine you're on that wild ride. Do you jump off when it gets scary? No, you hold on tight and enjoy the thrill. In his world, market volatility was not a problem, but an opportunity. When the market takes a nosedive, stocks often go on sale, just like those surprise discounts at your favorite store. It's a chance to buy quality stocks at a lower price. But how do you capitalize on market volatility without feeling like you're about to lose your lunch on the roller coaster? One strategy Lynch used was dollar cost averaging. It's like setting aside a fixed amount of money regularly to invest. When prices are low, you buy more shares, and when prices are high, you buy fewer. This spreads the risk and reduces the impact of market swings. Remember, investing is a long-term game, much like enjoying a series of thrilling rides at an amusement park. Don't let the sudden drops scare you away. Embrace them as part of the adventure. When the roller coaster of the market takes a dip, keep your cool and consider it an opportunity to snag some great deals. All right, my friends, now we're going to dive into Lynch's fascinating concept of 10 baggers. A term he coined for stocks that could multiply in value tenfold. It's like discovering a magic lamp that grants you 10 wishes, but in the world of investing. So here's the deal. Lynch didn't go hunting for just any stock. He was like a treasure hunter, searching for that one special gem hidden in the vast sea of investments. He sought out companies with a unique combination of qualities. His approach was simple and powerful. He looked for firms with strong growth potential. Think of it as planting a seed in fertile soil. These were companies that had a product or service with high demand, a competitive edge, and room for expansion. It's like finding a plot of land in a growing neighborhood. You know the value is bound to go up. And here's where the 10-bagger magic happened. Once Lynch had identified such a company, he'd hold on to it for the long term. No quick flips, no short-term games. It's like tending to your garden patiently, allowing the flowers to bloom. Now remember the video's title, How to Invest and Build Wealth? This is precisely what Lynch did. He invested with a vision of long-term wealth creation. The idea was to let these 10-baggers grow over time, like nurturing your investments and watching them mature into something truly remarkable. But, of course, Lynch's success wasn't built on luck. He was diligent in his research, like a detective uncovering clues. He wanted to be sure that the company's potential for growth was not just a mirage, but backed by strong fundamentals. In a world of quick fixes and instant gratification, Lynch's 10-bagger concept reminds us that patience, research, and a long-term perspective can be the keys to building lasting wealth. So, the next time you consider an investment, ask yourself if it has the potential to be a 10-bagger and contribute to your long-term wealth-building journey. Now let's move to the next topic from how to invest and build wealth that is long-term versus short-term investing. It's like choosing between a relaxing stroll and a sprint. Peter Lynch had a preference for the long-term approach, and here's why it's like enjoying a scenic road trip instead of a hectic city drive. When you invest for the long haul, you're in it for the journey, not just the destination. Long-term investing means holding on to your stocks for an extended period, often years or even decades. This strategy comes with some distinct advantages. First, it's less stressful. Imagine you're on a serene cruise ship instead of a turbulent speedboat. Long-term investors don't need to constantly check the stock market's daily ups and downs. Secondly, long-term investing can be more tax efficient. Think of it as paying lower taxes on your investments because tax rates are typically lower for assets held longer. So, you keep more of your hard-earned money. Now let's discuss the power of compounding. This is where it gets really exciting. It's like planting a tree in your garden and watching it grow over the years. When you leave your investments untouched and let them grow, your initial investment can snowball into something much larger. It's like watching your money make money on its own. But hold on, there's a place for short-term investing too. Just like taking a shortcut when you're in a hurry, short-term investments have their perks. They can offer quick gains, and you can react to market trends more rapidly. Short-term investing is like sprinting in a race. You need to stay on your toes and react swiftly. It suits those who enjoy active management and staying updated with market news. The key is to find a balance that works for you. Peter Lynch himself had a mix of both in his portfolio. He used long-term investments as the sturdy foundation and short-term plays as the cherry on top. So whether you prefer the slow and steady journey of long-term investing or the quick thrills of short-term trading, the important thing is to align your investment strategy with your personal goals, risk tolerance, and time commitment. There's no one-size-fits-all approach, so find what suits you best and enjoy the ride. Now let's talk about common investment mistakes from the topic, How to Invest and Build Wealth. Think of these missteps as those banana peels on your path to financial success. You definitely want to avoid slipping on them. One classic mistake is what we call herd mentality. Picture a flock of sheep following each other. Well, in investing, it's like everyone rushing to buy the same hot stock just because others are doing it. It's easy to get swept up in the excitement. But remember, blindly following the herd can lead to a cliff, and you might just be following them off it. Instead, be the shepherd of your own investment decisions. Another pitfall is timing the market. This is when people try to predict when stocks will rise or fall. It's like trying to predict the weather a year from now. Lynch often said that more money has been lost trying to predict market corrections than in the corrections themselves. So, what should you do? Focus on the long term and stay invested. You don't need a crystal ball, you need patience. Let's not forget about overconfidence. Sometimes when we have a string of successful investments, we start to think we're invincible. It's like nailing a few shots in a game of darts and believing you can hit bullseyes every time. Overconfidence can lead to risky decisions and big losses. Lynch's advice? Stay humble and never stop learning. Even the pros make mistakes. Ignoring diversification is another mistake you want to avoid. It's like putting all your eggs in one basket. If that basket tips over, you're in trouble. Peter Lynch was a big advocate for spreading your investments across different sectors and industries. That way, if one area takes a hit, your entire portfolio won't crumble. Next, there's the panic sell. Imagine you're on a roller coaster and it suddenly drops. That's how market volatility can feel. When the market takes a tumble, many investors hit the panic button and sell their stocks. But Lynch would often see these moments as buying opportunities. It's like selling your car when it hits a speed bump. Not the best decision. So, stay calm and consider buying more quality stocks on sale during market downturns. Remember, it's not about avoiding all mistakes, but learning from them. As Lynch would say, you get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets. So be prepared for bumps in the road, learn from your experiences, and keep moving forward on your investing journey. Now, let's move to the next topic from How to Invest and Build Wealth, which is the role of intuition in investing. You know that gut feeling you get when something just feels right or wrong? Well, in the world of investments, it's like having a secret weapon. Imagine you're in a bustling marketplace, trying to find the juiciest, ripest fruit. Your intuition guides you to pick the one that just feels perfect. In investing, your gut can be surprisingly accurate too. It's like having an internal radar that helps you navigate the complex stock market terrain. Peter Lynch, the investing guru himself, valued intuition. He often said it's like having an extra sense, a subtle whisper guiding you. However, intuition isn't a magic spell. It works best when combined with research and knowledge. Think of it as having a superpower, but also studying hard to understand how to use it wisely. Let's put it this way. Your intuition is like a trusted friend who knows you inside out. When it comes to investing, it might nudge you, saying, "Hey, this company feels promising," or "I have a bad feeling about this one." It's not about ignoring facts, but embracing that inner hunch. Lynch's approach was to listen to his intuition, but also back it up with solid research, like having a map while trusting your instincts during a treasure hunt. Sometimes, your gut feeling can pick up on subtle cues that numbers might miss, making it a valuable asset in the investing game. So here's the takeaway. Trust your intuition, but make it your investing sidekick, not the sole decision maker. Combine it with research, like blending your favorite flavors to create the perfect smoothie. With intuition and knowledge hand in hand, you'll be better equipped to make insightful investment choices. Now let's talk about building wealth through sustainable investments, the next topic from how to invest and build wealth. Imagine your money isn't just growing for you, but also making a positive impact on the world, much like planting a tree that not only provides shade, but also helps the environment. Peter Lynch wasn't just a savvy investor, he was also passionate about responsible investing. Sustainable investments are like supporting businesses that care about the environment, society, and ethical practices. It's like choosing products made from recycled materials, or supporting local farmers. You're not only benefiting yourself, but also contributing to a healthier planet and community. When you invest in companies that prioritize sustainability, you're contributing to a better future. Think of it as investing in a cleaner, greener tomorrow, where businesses focus on reducing carbon footprints and promoting social equality. Just like you'd invest in the education of your children for a brighter future, sustainable investments pave the way for a more sustainable world. Lynch understood the power of such investments. It's not just about the returns. It's about being part of a movement that values environmental conservation and social responsibility. It's like being part of a team where everyone works together for a common goal, a world where businesses thrive, people prosper, and the earth flourishes. So, consider sustainable investments as a way to grow your wealth while making a positive difference. It's like having your cake and eating it too, reaping financial benefits while also contributing to a sustainable and ethical world. By aligning your investments with responsible practices, you're not only securing your financial future, but also playing a vital role in shaping a better, more sustainable world for generations to come. And there you have it, friends, a comprehensive journey through the world of investing, guided by the wisdom of Peter Lynch. Remember, it's not just about making money, it's about understanding, learning, and making the world a better place through responsible investments. Now, if you're interested, get any audiobook of your choice for free using the link below the video. This video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. Always assess your risk tolerance and investment goals before allocating your capital. I recommend you watch the next video in our series. Don't hesitate to share this video, subscribe to our channel, and share your thoughts in the comments section. Thanks for watching.